Hello and welcome to another edition of AFR's Market Pulse. Today is July 30th and we have a lot to go over. This week is going to be very busy. Expect high volatility all week. We're going to get right into it. We're going to take a look at some charts and we're going to take a look at the event economic calendar here. And let me just make this a little bigger. Great. As you can see, the 10-year is somewhat static today, but if you look at the 3-month chart, we're seeing the 10-year. I mean, we're at 460 just 3 months ago, 465, and now we're sitting at 416, 417 on the 10-year, with the anticipation that potentially can go down further depending on what happens the rest of this week. Now, for data points today, FHFA came out with their HPI, and year over year, we're still looking at a 5.7% increase year over year, but month over month was flat. So get ready for a lot of that clickbait on social media about the housing crash. But one important thing we have to look at when it comes to housing and obviously the equity that's been built is delinquency data. We have never had a stronger credit quality with lower DTIs, higher FICOs, and a ton of equity ever. This is the best securitizations, at least in the modern mortgage era. So we have to pay attention to the delinquency data, and that still shows that it's incredibly low pre-pandemic levels. So we're sitting good there. So don't expect a housing crash anytime soon. So we're taking a look there, and then other data points that come out today or comes out this week. We're looking at ADP jobs tomorrow. And then in the afternoon, we're looking obviously at the Fed meeting and the Fed rate decision. We anticipate they're going to stay flat. That's like the market is saying they're going to stay flat. And then we're going to have our Fed presser. And we know Jerome likes to do Jerome things. So hopefully he doesn't ruin this little bit of a run that we've had. But if he talks through it, and I think the sentiment is that we're going to see a rate cut in September, but we'll have to find out. We'll go into the CME charts in a second. The rest of the week, we're going to see on Thursday, we have ISM data coming out, but really the big one is Friday. Friday, the BLS jobs report comes out, the non-farm payrolls, and that comes out, and we're going to see unemployment rate. If we see that unemployment rate rise and see maybe a little bit of a miss in the employment numbers, you should expect to see a rate cut coming soon. So we expect to see that in September. And the market agrees. They're taking a look, and there's an 87.7% chance we're going to see a 25 basis point cut. Nobody thinks we're going to stay flat now. So the market is showing that this is where it's going. And really the first rate cut is going to be very interesting. Historically, usually that first cut, that shift in sentiment, that change in direction from the Fed causes a little bit of volatility, but everybody's kind of pricing in that one cut. So we're going to see what Jerome says tomorrow during his presser that could potentially move markets. So expect a lot of volatility, and then we'll see either confirmation of that based on that jobs report on Friday. Now, one of the questions that we get a lot here at AFR, we're seeing a lot of questions around interest rates. And why is it that certain interest rates pay more than other interest rates? A higher interest rate might pay less than a lower interest rate. And I wanted to get into it a little bit today. We just want to provide one item of value or something that you can take back and maybe help you when you're selling a loan or when you're trying to price a loan out. So we want to go ahead and provide you with a little bit of information, a little bit of insight. I'm using the FHA pricing here from our rate sheet today and as an explanation point of why. And here you can see that 6.25, 6.75, and 7.25 are all pricing better than rates that are higher. And why is that? Well, in Ginnie Mae, in Ginnie Mae securitizations, certain note rates have optionality on which coupon that loan can go into. So if you take a look, I'm using 675 as an example here. Here, you have an option with 675. You can either put it into a Ginnie 6.0 coupon, or you can put it into a Ginnie Mae 6.5. The difference is how much servicing you're going to end up keeping. And it's only available on these note rates. You can't do it on other note rates. So here you have an option to keep either 25 basis points or 75 basis points in servicing. Now there's a G fee, so I'm using these numbers to make it a little bit easier in doing the calculations. But if you take a look at it, the difference between the 6 coupon and the 6.5 coupon, you're going to see it's only about 84 basis points. Well, if there's an 84 basis point change and the difference in servicing is 50 basis points, if you have any sort of multiple, if there's a 2x or a 3x on that servicing, if there's a value put to that servicing, which we'll do a write-up on that on our next AFR Market Pulse, we'll talk about servicing rights. But if you have a multiple on that servicing right, as you can see, it far exceeds the difference in coupon here. So you're going to see when loans slot to a lower coupon, that the pricing is going to get better than even a rate that's higher. So 6875 is paying 101.687, and here 675 is paying 102.211. So you're seeing the lower rate is pricing better. Now, why is this important? If you're pricing in a pricing engine, let's just say you're pricing in an LOS like Arrive. If you're in Arrive, you're going to see that the pricing and how the default setting for viewing a pricing scenario is going to come up as it's lender based, and it's going to take the interest rate closest to par, and it's going to display that interest rate, unless you choose a desired rate. But if you did the default run, that's what's going to come back with. So now what you have to do is open up those rate stacks. So you're going to see opportunity. Now it may show 7.375 or 7.5 or 7.625 is closest to par, but really if you chose 6.75, you might be able to get even a better deal for your borrower, driving that rate much lower for very minimal costs, where there's some recoupment periods of like less than a year. So it makes a lot of sense to open up your rate stacks, find those interest rates. This happens on conventional as well. Find the interest rates and then run your pricing scenario in Arrive if you're using that LOS with a desired rate. So here we'd run it, check 6.75, and then see which lender is the most competitive at that interest rate versus doing the default settings. Now, Loan Sifter, it shows a little bit different, and some of the other engines show a little bit different. They do by note rate and which investor is best, but always open up those rate stacks. It makes a lot of sense, can save your borrowers a lot of money, and potentially win you another loan. So that's all we have for you today at AFR's Market Pulse. Looking forward to doing this again. We're going to come back on Thursday after the Fed meeting and do a full recap of the Jerome Powell presser. Talk to you then.